The moment oil starts moving with fear, everything else follows. Right now, the world is watching tensions around Iran escalate, and markets are reacting before the headlines even settle. This isn't just another geopolitical story. This is the kind of trigger that ripples through fuel prices, supply chains, grocery bills, and ultimately, the mood of every consumer trying to make sense of it all. Here's where it begins: energy. Iran sits in one of the most critical regions for global oil supply. When conflict risk rises, traders don't wait for disruption to happen. They price in the possibility. Oil spikes not because barrels disappeared overnight, but because uncertainty becomes the most expensive commodity on the planet. And once oil moves, inflation doesn't ask for permission. Transportation costs climb first. Shipping companies adjust rates. Airlines respond almost immediately. Trucking firms pass costs down the chain. Within weeks, that increase shows up everywhere, from the cost of fresh produce to the price of everyday goods sitting on store shelves. But here's what most people miss. Inflation isn't just about higher prices. It's about expectations. When businesses expect costs to rise, they raise prices in advance. When consumers expect prices to rise, they spend differently. Some rush to buy now, others pull back entirely. That shift in behavior is what creates instability, and that's exactly what we're seeing. Consumer sentiment is collapsing. Surveys are showing a sharp drop in how people feel about the economy, their financial future, and their willingness to spend. This isn't just data, it's psychology. When confidence breaks, spending slows, and when spending slows, the entire system starts to strain. Think about it like this. The global economy runs on one simple engine: people buying things. When that engine hesitates, businesses notice immediately. Inventory builds up. Revenue projections get cut. Hiring slows down. Layoffs begin to enter the conversation. Now add another layer: central banks. They've been fighting inflation aggressively. Interest rates have been pushed higher to cool demand. The idea is simple: make borrowing more expensive so people spend less, which brings prices down. But now there's a problem. If inflation rises again because of energy shocks, central banks are trapped. They can't easily lower rates because inflation is still a threat. But keeping rates high while consumer confidence drops creates pressure from both sides. That's where things start to break. The stock market doesn't crash because of a single headline. It cracks under pressure. Right now, that pressure is building from multiple directions. Higher energy costs, weakening consumer confidence, tight financial conditions, geopolitical uncertainty. Each one alone is manageable. Together, they create a fragile environment. Let's talk about stocks. Markets have been riding on optimism for a while. Strong earnings, resilient consumers, and the belief that inflation was under control. But markets are forward-looking. They don't wait for problems to fully show up in data. They anticipate. If investors start to believe that rising tensions will push inflation back up and slow economic growth at the same time, that's the worst-case combination. That's called stagflation pressure. And markets hate it, because in that scenario, companies face higher costs while consumers spend less. Margins shrink, growth stalls, valuations suddenly look too expensive. So what happens next? Money moves. Investors start rotating out of risk. High-growth stocks become vulnerable. Speculative assets lose support. Even strong companies can get dragged down simply because liquidity tightens. And once selling begins, it feeds on itself. Algorithms react. Stop losses trigger. Fear spreads faster than logic. The same momentum that pushed markets up can accelerate them downward. But here's the key question. Is a crash inevitable? Not necessarily. Markets don't move in straight lines. And they don't respond to headlines alone. They respond to how those headlines translate into real economic impact. If tensions de-escalate, oil stabilizes, inflation pressure eases, confidence can recover. But if escalation continues, the situation changes. Supply disruptions become real, not theoretical. Energy prices stay elevated. Inflation sticks around longer than expected. Central banks stay restrictive. Growth slows further. That's when risk increases significantly. Now step back for a second. This isn't just about markets or charts. This is about everyday life. When inflation rises, it changes behavior at every level. Families cut back on non-essential spending. Businesses delay expansion. Investors become defensive. Lenders tighten standards. It becomes a cycle, and cycles are powerful. They don't need dramatic events to continue. They sustain themselves through feedback loops. Lower confidence leads to lower spending. Lower spending leads to weaker growth. Weaker growth reinforces lower confidence. That's the real danger. Not just a spike in oil, not just a drop in sentiment, but the connection between them. Right now, that connection is getting stronger. So where does this leave us? At a turning point. Markets are watching every signal. Energy prices, inflation data, central bank language, and most importantly, consumer behavior. Because at the end of the day, consumers decide the direction of the economy. Not politicians, not analysts, not even central banks. If people keep spending, the system holds together. If they pull back, everything adjusts. And that adjustment can be fast. Faster than most expect. That's why this moment matters. It's not just about what's happening today. It's about what happens next. Do tensions cool down? Or do they escalate? Do prices stabilize? Or do they surge again? Do consumers regain confidence? Or does fear take over? Those answers will define the path forward. For now, the warning signs are there. Rising geopolitical risk, renewed inflation pressure, collapsing consumer sentiment, and a market that's starting to question its own optimism. Put all of that together, and you get a system under stress. Not broken, but definitely strained. And when systems are strained, small shocks can have big consequences. So keep watching, because the next move won't come from one factor alone. It will come from how all of these forces collide. And when they do, the reaction could be sharper than most are prepared for. If you want to stay ahead of these shifts and understand what's really driving the market beneath the headlines, hit subscribe and stay with me for the next breakdown.